So for today, since I didn't go not that long ago, I wanted to do a little bit kind of a masterclass from a home buying experience. I'm sure most of us have either gone through the process or are about to experience the process. So I said, what better way to show you how we can service our clients and our partners than to actually kind of take you guys through that roadmap, okay? So we're gonna go through quite a bit of slides for the sake of time, and then hopefully I'll try to leave some time for questions. So this is a big one, right? Obviously, the cost of waiting to buy a home. When we're sitting down with a consumer, the most important part we need to find out, some of you guys have read Simon Sinek's Start with Why, right? And we ask in the order of, why are you looking to buy a home? How can we assist you? And what are the products we offer? In many instances, sometimes think about it when we meet with clients, it's what can we do to help you, how we can do it, and then we ask what. Do it in the reverse. So in this case, you'll see for an average consumer, if they're looking to buy a home, if they wait, even with interest rates somewhat elevated over the last month with some of the things happening geopolitically, you'll kind of see that the consumer will miss out on roughly about $40,000 of home equity. Most of us who owned a home and purchased it prior to COVID, there's obviously over 50, 60% plus in home appreciation. I mean, your home has essentially doubled and then some, right? And then obviously the difference on the right side, when we put this analytically in front of the consumer, in about 9 years statistically, they're gonna gain roughly about $241,000 in home appreciation. A big part that we do when we're talking to our consumers is obviously education. Most of us heard last week, the Federal Reserve decided to hold interest rates again, right? Obviously some of our jobs are being affected by that in terms of cost of gas and things like that, but the important part we tell the consumers is the federal funds rate is not the same thing as mortgage interest rates, okay? When we sit down with a consumer, they always ask us, well, what do you guys do in order to assess our qualification? I always call it the 4 C's. So we take a look at their capacity, which most of us has heard of debt to income. How much do you make if you're a W-2 employee gross relative to if you're self-employed net? Capital, what's your skin in the game? Where is your money coming from? Is it seasoned? Is it sourced? Most of us know you have the opportunity to also tap into retirement accounts, 401ks, stocks, and what have you in order to pull that money or get a gift. Credit is a big factor, right? Credit, we're gonna go over on the next slide of some of the different factors that affect it. And then the last one is collateral. What type of home are you looking to purchase? Single family home, condo, townhome. Based on those specific assets, there are certain restrictions based on that. In terms of credit score, you guys probably have seen this before on the left side. This is essentially off of a FICO credit score, which is what the majority of mortgage lenders are doing. There is some legislation currently out there where they want the Vantage credit score to start going into place. You usually see that with Credit Karma, or usually CreditWise and some vendors out there. Those don't give too much weight towards utilization. That happens to be a big part of what clients usually get impacted. They're just maxing out their credit cards. 30% credit utilization, 15% of their length of history, 10% new credit, 10% credit mix, 35% payment history. A big portion of it is how many of us have opened up a card in college or when we were younger, never closed a credit card. Right? Your history diminishes, your balance is owed diminishes as well, and you obviously are at a disadvantage. A big part, again, debt to income. How do we do the math quickly? I can easily assess a consumer from a qualification perspective doing the numbers in our head. For example, if a client makes hypothetically $10,000 gross a month, we reverse engineer. 50% of that is what? $5,000. Then we subtract whatever monthly liabilities that they have, hypothetically car payments, minimum payments on credit cards, installment notes. If it's $1,000, the max mortgage payment a client can qualify for is what? $4,000, right? 5 times 4, we work our way backwards from there. Again, when we qualify for a mortgage, your mortgage payment is generally comprised of what? Your pay, your principal, your interest, your taxes, and your insurance. If you're purchasing a condo or a townhome, you have that HOA fee involved. We're going to talk a little bit about condos and some of the stuff that we have there. Different loan programs out there. Your traditional FHA, VA, USDA conventional. VA, of course, is reserved for those of us who served in the military. USDA, we don't see too much in New Jersey, maybe closer to like Orchid River and some urban areas, or I should say agricultural areas. FHA is generally what most first-time homebuyers generally take advantage of. You do not have to be a first-time homebuyer to purchase an FHA loan. That's a myth a lot of people have. And then, of course, conventional is that creme de creme. You can put as low as 3% down on a conventional loan with some medium income restrictions, or 5%. I've talked time and time again, every single time I come up, about our business owners and some of the non-qualified mortgage options. Non-QM loans about 4 years ago comprised of less than 5% of the business. As of this year, from the statistic when I was in DC, it's roughly about 25%. So 25%, $1.7 trillion was done with an opulent loan. A bank statement loan, P&L loan, or DSL, right? You'll see here again, when we talk, how many of us have asked when we purchase a home, what's my interest rate and what's my APR? The APR is always going to be slightly higher because it's the total cost of finance. It's your interest rate plus your closing costs, your prepaid, your escrows, and any fees involved. A big portion of it, if you guys have purchased a home previously, you'll notice under Section A of your loan estimate or your CD, use generally where the bank fees are, you're going to have discount rates. A lot of consumers, again, they're fixated on getting a 5.9 over a 6.25. We do such a thorough assessment up front, utilizing technology, breaking it down in front of them, and kind of find that break-even point. If you're buying a $500,000 home and you're putting 1% down, that's $5,000. Does it make necessary sense in order to pay that? So, continuing on, you guys will see down payment assistance is a big part. If the client is looking to qualify for down payment assistance, there's some state grants based on some restrictions that they have that they currently go through. You'll also take a look on the next slide, some different changes on the process, right? They get pre-approved, they go under contract, they go through processing, underwriting, clear to close, and then closing. Different strategies right now as we head into spring and summer market. Some of the real estate professionals would love this. We go over escalation clauses, right? Where you place an offer and you basically say, as a little piggyback, if someone comes in higher, we will match it. Limiting inspections such as environmental, structural, mechanical, appraisal gaps, and things along that nature. Appraisal gaps is a big one right now, right? Many homes are generally appraising for what they're worth. The importance of choosing the right professional, especially a consumer, 5 different strategies. The client can either pay a difference. They can obviously negotiate with the seller if they did not waive it. Meet in the middle and negotiate, challenge the dispute, which is very difficult to argue with an appraiser on the value, and then a PMI shuffle, being able to shift a PMI. On the next one, you'll see condos. Condos is a huge thing right now, some restrictions. You're going to see some restrictions on, they're increasing now to a 15% reserve. It used to be 10% down. That's going to injure a lot of HOAs. We're seeing a lot of HOA fees start to go up as well. A lot of litigations involved for some of our attorneys that we see slip and falls are affecting condos eligibility. Self-employed borrowers have talked time and time again on bank statement loans and things along that nature. And I'll leave us with this, some of the strategies. If we're working with a consumer, whether it's our children, ourselves, there are obviously different paths to it, right, that we're gonna guide them, 30, 60, 90, and so on and so forth. Closing costs is not a fixed percentage. It varies based on the home, and it varies based on the type that they're looking at. And then we'll kind of go through the circle of life, as I call it. If any of us have bought a home, 3.5% down to 5% down, we're going through kind of those phases. And then we'll see some of the different changes that you'll go through, renting it out, repeating, and so on and so forth. And then here are different exceptions, and I'll leave it at 6, right? We've done student loan exceptions with a consumer. We are a direct lender, giving us some of that opportunity where a traditional lender might necessarily not want to touch a client with a 576 credit score. We'll have the ability to give that exception and take it from there. All right, guys?